All right, let's jump right in. If you're a small business owner, you know that workers' compensation insurance can feel like a total maze, right? It's all regulations, high costs, and just so much paperwork. But what if there was a way to make it all a whole lot simpler? Today, we're going to break down exactly how a professional employer organization, you'll hear it called a PEO, fits into that picture. And wow, does that hit the nail on the head? This quote really gets to the core of it. Look, workers' comp is absolutely non-negotiable. You have to have it. But man, it is often incredibly expensive, legally complicated, and it's this huge administrative black hole that just sucks up time you should be spending on, actually running your business. So here's our game plan for this explainer. We're going to start with the challenge itself. Then we'll get into what a PEO and this co-employment thing are all about. After that, we'll see exactly how they tackle workers' comp, weigh the good with the bad, and finally help you figure out how to make the right call for your company. Okay, first things first. Let's really set the stage and look at why workers' comp is such a major hurdle for so many business owners out there. When you look at these points, they're not just small annoyances, are they? For a small or medium-sized business, those high premiums can be a real killer for your cash flow. Managing just one claim can feel like a full-time job. And trying to keep up with state laws that are always changing, you're constantly worried about getting hit with a fine for noncompliance. It's a massive weight that pulls your focus away from what really matters. So, we've laid out the problem pretty clearly. Now, let's talk about a potential solution. In this part, we're going to define the two key ideas you absolutely need to get, the PEO itself and the co-employment model that makes it all work. The easiest way to think about a PEO is like a shared expert HR department. It's a company that partners with your business to handle all those complicated, time-consuming employee tasks. We're talking payroll, benefits, compliance, and yes, workers' comp, all under one expert roof. Now this right here, this is the secret sauce. Co-employment does not mean you're giving up your company, not at all. It's a legal partnership, sometimes called a joint employer setup, where you and the PEO share employer duties. You still run the show. You manage your team's day-to-day work, you set their schedules, you drive the business. The PEO just steps in to become the employer of record for all the administrative and legal stuff. And this chart breaks down that division of labor perfectly. See? You're still in the driver's seat for everything that makes your company your company. The daily operations, the sales, the culture. The PEO, on the other hand, takes over the heavy lifting on the back end. They're handling payroll and taxes, managing any workers' comp claims, and making sure you stay compliant with all the rules and regs. So let's get down to the nitty-gritty. How does this partnership actually play out when it comes to something as complicated as workers' compensation? Let's break down that process. A PEO really attacks the workers' comp problem from all sides. First, and this is a big one, they use their massive size to get better insurance rates than you could ever get alone. If an injury does happen, their team handles the entire messy claims process for you. They're also experts on compliance, keeping you out of trouble. And maybe most importantly, they're proactive, helping you set up safety programs to stop accidents from happening in the first place. This idea of group buying power is probably the biggest financial reason people look into PEOs. Think about it. They take all the employees from all their clients and bundle them into one giant group. Suddenly, they're a huge, very attractive customer for insurance companies. That gives them some serious negotiating power that a small business just doesn't have. And that often leads to much lower premiums for you. But of course, no single solution is a perfect fit for every single business. So let's be balanced here and take a hard look at both the advantages and the potential drawbacks of using a PEO for your workers' comp. Okay, on the pro side, the benefits are pretty powerful. You're often looking at real cost savings, not just from better premiums, but also from things like pay-as-you-go billing, which is great for cash flow. You get to hand off a huge mountain of administrative work. You get instant access to safety and compliance experts. And for higher-risk industries like construction, you can often get access to way better coverage. All of this frees you up to do what you do best, grow your business. Now, on the flip side, there are some definite trade-offs you need to think about. You'll probably have less flexibility since you have to use the insurance carriers the PEO already has contracts with. You're usually signing up for a long-term deal, at least a year. And you've got to keep an eye on the invoices. Sometimes they can be complex, and you want to make sure admin fees aren't creeping up. It is a partnership, and that means you are handing over some direct control. And that all leads us to the million-dollar question, doesn't it? Now that we understand what a PEO is, what it does, and the pros and cons, how in the world do you figure out if this is actually the right move for your business? To answer that, we're going to get super practical.
This last section is all about taking everything we've talked about and turning it into a real, actionable guide to help you make a smart, informed decision. So, who does this typically make the most sense for? Well, PEOs are often a perfect match for businesses in that sweet spot of about 10 to 500 employees. They're especially a game changer for companies in high-risk fields that really struggle to get affordable insurance on their own. And honestly, if you're an owner who just wants to hand off all the admin headaches so you can focus on growth, a PEO should definitely be on your radar. Okay, before you sign on the dotted line with anyone, you have to watch out for a few red flags. The first, and maybe the biggest one, is a lack of transparency. If you look at a proposal or a sample invoice and it's impossible to figure out what you're actually paying for, that's a problem. All fees should be crystal clear.
Red flag number 2, vague language in the contract. You need to read the fine print, especially around liability. Remember, a huge benefit here is sharing that employer liability. If the contract has tricky wording that seems to push all the risk back onto you, it kind of defeats the purpose, right? The agreement is supposed to protect you. And finally, you have to know your exit strategy before you even start. Most PEO contracts are long-term. You need to know exactly what happens if you want to leave. What are the penalties for terminating early? If those penalties are really steep, you could get locked into a service you're not happy with, and that's a tough spot to be in. So to wrap this all up, here is your evaluation checklist. These are the questions you should be asking any PEO you talk to. Ask about their certifications. Insist on seeing a sample invoice. Make sure their insurance is fully insured. Ask to speak to a few of their current clients, preferably ones in your industry. A good, reputable PEO will have no problem answering any of these questions. And that's really the bottom line here. Picking a PEO isn't like buying office supplies. It's a major strategic decision. It's a partnership that gets woven right into the fabric of your business. The time you spend doing your homework up front, really vetting your options, is the absolute best thing you can do to make sure you end up with a partner that's going to help you, not hold you back.